Oh, thanks, my man, Richard. Good to see you.
Great. So we'll continue. So I want to talk to you about your corporate experience. You've been a CFO and a CEO. So talk to us about that.
Yeah, that came quite a bit later in my career. It takes a while to get up to C level, kind of what they call the C suite, all the CEO, and that's a Chief Executive Officer and CFO, Chief Financial Officer. Um, when I actually started to do those roles was when I took two companies public that were startups that I had been involved in, and I took them public at first. One was as a CFO, and so wrote the initial forms to go public, the prospectus, and then what we did for going public at that time was not go through the traditional IPO, initial public offering steps, but where you basically hire an investment bank and they control it and they place all of the stock that you're going to be issuing. And then you go through the prospectus period and you go on the road and talk to everybody. And then you have a date where you ring the bell on the stock exchange and you go public. And it's interesting in that process, a lot of times the investment banks, they do all that work, but they give the stock to their best clients because what they do is they price it lower than they think it's going to be on opening day. And so all of their clients that bought into it make a whole bunch of money on the first day. And that's great for the investment bank and for their clients that they place the equity with. But it's not so great for the company, right? The company loses that value between what it's issued at and what it starts trading at. Um, so what we did was it was a complicated process and really difficult to do today. This was back in the early 2000s, and it was to do a direct listing where we just did the prospectus and then went out, found the investors and found the market makers, and then just started the market makers. They make a market in your stock. They hold some of the stock and they do the bid price and the ask price, and so that they bring together the people want to sell the stock and the people want to buy the stock, and they do those transactions. And so as things got more digital, those market makers used to be guys right on the floor of the New York Stock Exchange. They'd wear those yellow coats and stuff, and they had a little book of their transactions, and they would hold some of the stock and they would say who wants to buy, who wants to sell, and people would shout and they would trade, and they were the ones that would make the market in your stock. And in particular, each stock had its own little trading place on the floor, and they would provide liquidity. Liquidity means that they provide the ability for bid and ask. The stock market is basically it's an auction. It's like eBay. Somebody says, I'll buy that stock for $100, and somebody says, I'll sell that stock for $120. Well, there's a gap there, and that's called the spread. And then the market maker says, okay, let's make a deal here. Let's, agree on $110. And then the bid guy comes up and the ask guy goes down, and they make a deal. And that's the last trade. And so you see those when you look even on your Charles Schwab or you look on Google or whatever, and you will see the bid, the ask, and the last trade. And the last trade is usually between those two. And that moves all day long. That's what you see, those little squiggly lines. Every single transaction, like say if you're doing 1,000 transactions on eBay a minute, you'd see all those ones, and that's what makes the stock price. So the stock price, the stock market is considered a price discovery mechanism because you're actually discovering the price. You don't know what a share of Google or a share of Apple is worth, other than what the market says it's worth, what people are willing to buy it for and sell it for, and where a trade is made. So that's price discovery, and that's one of the beautiful mechanisms of the stock market. Is actually allows us to discover the price, and it's the wisdom of crowds. The people there's lots of people that say, well, like we talked last time, the present value. There, people are making guesses about what the income stream is going to be in the future of these companies, discounting that back to a present value and saying, that's what I think this company is worth today. A lot of times, we just do that intuitively. And we might say, oh, Ford is worth this and Apple is worth that and Facebook, Meta is worth this. But that's actually the assumptions that people are going through every time they make a trade. And those wisdom of crowds is actually an incredibly accurate way to come up with a price, a guess. One sort of just a story interesting to that, that all these people guessing is what makes that price and makes that value, and it's accurate in a way because it's just a guess about what the future is going to be. The first guy who did that was a guy named Francis Galton, and he did it in the late 1800s. And he was this polymath from England. And what he did was he invented a whole bunch of different mathematics and discoveries, all this kind of stuff. But one of the things he did was he was in his 80s, and he went to a county fair. This is how thoughtful this guy was all the time. Went to a county fair and they were doing this thing, guess the weight of the cow, and they had this cow there, and people would put in their guesses and then you could win a prize, right? And nobody guessed the weight right. But Galton, in his wisdom, got all of the different guesses and then he wrote them all down and averaged them all up. And the average of all of those guesses was spot on accurate to what the weight of that cow was. And that's called the wisdom of crowds. No one got it right, but there was some people that overdid it, some people that underestimated, and all those averaged together was right on the money. And that's basically a phenomenon that we don't really have a good mathematical, scientific explanation for why that happens. We just know that it does happen. And so the stock market is a similar thing. We have all these people making these guesses about the price of the stock, and that price is considered to be incredibly accurate because of that wisdom of crowds. So that's sort of a big, long aside, but I always think that's fascinating. The stock market's such a wonderful place it's like crowdfunding. It aggregates the money, deploys it to all these promising activities, and then those companies can go and flourish, and that makes economic prosperity for everybody. So it's a wonderful thing. So that's why I'd like to be involved in that. So yeah, I took these two companies public, and then once you're a public company, it's much different than being a private company as far as how much work you have to do to report. Because one of the big things, like we talked last time, Richard, was, how do you ensure that, the books aren't cooked and the numbers aren't fraudulent and all that? Well, that's the big thing that the Securities and Exchange Commission was created in the 1930s after the stock market crash in 1929 to take care of. And one of their big things was every company has to report audited financials once a year. That's called the 10K, their annual report. And then every quarter, there's a 10Q that you have to update your 10K, that annual report. So every quarter you have to do a 10Q. Every year you have to do a 10K, and then you do 3 10Qs, and you have to do another 10K. And that is an elaborate process. You have auditors that come in and look at all of your financials, everything that you're doing, the accounting. They do all the test work. They make sure everything is done properly. And then there's this part of it too, reporting called controls and procedures, and that just came in the 2000s in the Sarbanes-Oxley rulings, that you have to have and define what your controls or procedures are to make it so the company cannot be fraud can't be committed in the company. And that means that there's what they call separation of duties. The people that take in the accounts payable, say you have invoices that come in, they have to, and by mail or by email now, and then they have to be separate from the people that write the checks, and also that somebody can't say, oh, there's a check that we have to write for $10,000 for this cost, and it's really going to them, so you have to have all those people be independent, all those different series in that, who pays the bills, who puts the bills into the accounting system, and then people that oversee that process. So that's controls and procedures, and you have to sign off on that as the CFO every quarter. And it's your responsibility now. You can go to jail if it turns out that you were doing that fraudulently, because there's no way to really stop it. Say 3 or 4 people in a company who get together and say, okay, we'll do this, and then we'll split the fraudulent proceeds. So They put the onus on the CFO and the CEO that when they sign those 10Ks and 10Qs, that they're liable that those things are done right. If it turns out that these books were cooked in some way, those people have huge penalties, assigned to it. So the responsibilities before like 2006 or seven, when the Sarbanes-Oxley came in, they didn't have those responsibilities. So they were a lot looser with the way that they played those kind of games. So that's it's a tough job to do. And so a lot of companies don't like, one of the drawbacks of going public are that you have suddenly this incredible burden of reporting and all. One of the positives are, though, that then you have what they call liquidity. You have the ability, suddenly those shares, that ownership in that company is no longer just paper. You can actually sell it. It has a monetary value, and you can, sell some of your stock shares and get money for that. And you can't really do that before you're public. It's much more difficult. And it's also a lot easier to raise money as a public company, because then you have that price discovery mechanism. You know what the company's really worth because the market tells you. And then people can buy stock in your company and then sell it, or feel comfortable that they can sell it when they want. That's one of the challenges of having a startup. When you're an entrepreneur and you go and raise angel money or venture capital money, I'm an angel investor, that money is illiquid. You put $100,000 into a company that you think is going to be, the next Google or something, and you can't get that investment back until they have some sort of an exit event. Either they sell the company is acquired by a bigger company, and then that company pays the shareholders, or it goes public, and then those shareholders can sell their shares on the stock market and stuff. And that can usually take 5 years, maybe 10 years. And in that time, your money's tied up. It's not an income producing asset like a rental property or something where you're getting the rent each month or something. You get nothing, and hopefully you have this big payday at the end, but it's so risky. So that's one of the two benefits of going public. For the principals, they can liquidate some of their holdings and make money. And for raising money, you have this price that's pretty solid that you can point to, and also the investors can feel comfortable that they have a liquid investment. If they need to get out of it because they got to go buy a new car, whatever, they can sell some shares and get the money.
What are some mistakes that you see companies make in regards to corporate finance?
I'm sorry, Richard, what companies are making?
No, mistakes that you see companies make in regards to corporate finance.
Mistakes, yeah. Well, there's a lot of mistakes. I can tell you some of the ones that I made, that, from my opinion. One is selling. You can sell. Initially, I sold stock as a convertible debenture. And that means a debenture is just a debt. It's like a loan. And that loan can be converted into shares of stock. And I got taken a couple of times by, savvy investors. They were relatively unscrupulous. I would say they were bad. There's a lot of sharks out there. It's incredibly dangerous, to swim in those waters, because a lot of people want to rip you off. And I got ripped off a company 2 times selling convertible debentures, and they could they could convert to the stock at a discount from the stock price that was trading. And so they could convert, say, at a 25% discount to the stock price. Well, they would convert at that price, some of their debenture, sell it, and make money, and they could continue to do that, and they'd made a bunch of money. But that downward pressure on the stock price made the stock go way down. And so that's called it's a death spiral is what they call it. You're sort of circling the drain of a toilet, at that point, because they sell the stock price goes down, they sell more of it, they convert more, the stock price goes down, they convert more, and they're making money, they're making a ton of money, and all that hard work that you did is going up in smoke because of these unscrupulous investors. So that's a mistake that can be made, is you make a bad financial deal, because at the time I was naive. I didn't know enough about it to not be taken advantage. I thought, okay, great. These guys want to, give money to the company. I'm going to use that money in productive ways. But it undermined all of my efforts and all. So that can be incredibly frustrating, and it can also be incredibly damaging to the company, to yourself as a principal, as an owner, and it also can be damaging to the other shareholders that are, it's your responsibility to make sure that those shareholders are taken care of. And when you make a bad deal, it really can haunt you. So it's not all fun and games, I can tell you that. It's really a tough business, and there's a lot of people out there that are out to take away the value that you've created. So you have to be incredibly careful in making those deals. That's why a lot of times people rely on investment banks and things, even though they take a huge chunk to do stuff. At least you know that they know what they're doing, they're experienced, hopefully, and they're not trying to rip you off, that they have a fiduciary responsibility to you as a company. So yeah, there's a lot of mistakes, and there's also pressures that can be made, put on people, corporate finance wise. You're in that position, and if you just could somehow finagle, the accounting a little bit to make it look like you made a little bit more money, then the stock price would go up and everything would be great. So there's lots of pressures to and they're incremental pressures too, to sort of to make things look better than they are in the books, maybe book some sales quicker than they actually are made, or all kinds of things that can be a lot of pressure to maybe do things that are not totally transparent and correct. So that's another thing. You have to be willing to have the courage and fortitude and strength not to give in to all these pressures from investors and from employees and from customers and all those kind of things. So yeah, it's a challenge. It's a real challenge to be, but it's also incredible. It can be incredibly satisfying. It's great work. You're creating a company. You're making it grow. Your products and services are helping people. So it's always that balance, and not try to do things too fast or to cut corners is really can be take incredible discipline.
Talk to us about your entrepreneur journey. You've co-founded several companies, so talk to us about that.
Oh yeah, thanks, Richard. Well, yeah, I've founded and co-founded, about 20 companies. Some of them have been, really successful for me. Other ones have been right down, and others have sort of, putted along and been stable, but not really made, super amounts of money. But it depends. Sometimes you want to hit a grand slam, like in baseball, right? And sometimes you just want to get on base, have a solid single, or even walk. So some of those companies that are stable but not really super growth companies have been very, very fruitful for me. And when you look at companies, it turns out, if you're going to raise money, and go the startup route, you have to have a company that is going to really, really grow super, super fast. And then you raise money, and then those people, those investors, those venture capital or startup angel investors, which I've become one of those, is they want you to move really fast and grow the company and then sell it so that they can get their return, right? So there's a lot of pressures there. In my experience, I started out doing those kind of companies. I thought, oh, want to be an entrepreneur, raise venture capital, take companies public, and then, that would be the grand, great thing. And I did that, and it's great, but it's a lot of pressure and it's an incredible amount of work. And now what I like to do more is companies where I keep total ownership. I have no co-founders. I really have no employees. I do everything automated. Everything is digital first, so I don't have working capital tied up in inventory and things, because all digital products that I have, they're costless. Once I make them, it doesn't cost me more to make one copy or a million copies of a digital download, right? Like a video file or a PDF book or something. So that kind of way of doing business has become very attractive to me. I don't like to raise money outside because, from outside investors, because then you have the pressure of them asking you to perform. You're basically, you're buying yourself a boss. And I wanted to get away from having bosses. And nowadays, with the internet and with all these digital platforms, even what we're doing here, it's incredible, to have a podcast that can be distributed all around the world. And it's not that expensive to do. The barriers to entry, it's not like, what used to be to have a TV station, and how could you possibly own a TV station or a recording studio and all those kind of things, all the video equipment, and then the distribution was really possible. Now we can do all these things, so we can actually have companies that we really own just by ourselves, and we don't have other people telling us what to do, or we have to sort of compromise because we have partners and things that want to do a little bit different. We can do just what we want to do when we want to do it, and make our dreams come true. I mean, in a way, you, you reveal yourself to yourself through the actions that you do, and so you see what happens, and that sort of reveals who you are. And so it's a really exciting time to be an entrepreneur or a solopreneur, where you're just doing it by yourself, and use all of these different automation tools to help you. They're like employees, but they don't need vacations or salaries. You just pay for the platforms and things. So that's been my entrepreneurial journey. I ended up taking two companies public. I had a couple of companies that fell apart because I had partners that just couldn't, they didn't match up. Very talented people, incredibly talented people, but one might be a creative person, it might be, really, liberal or whatever, and one, and great, and then another person who is an operations person, and they're more rigid, and maybe they're from, a military background, and they're more conservative, and you have these people that are just like they don't agree personality wise, and you try as a CEO, or to hold it together long enough to have a big payday, so everybody, try to compromise, try to make everybody happy. And sometimes that works, and sometimes it just falls apart. And that can be very frustrating and painful. People, do a lot of work, and you want them to see the fruits of their labors. But sometimes, for whatever reasons, things fall apart. So a lot of it has to do with managing personalities, and that it can be another, you have to be a psychologist, and you have to be a babysitter, whatever, sometimes. And so that can be challenging as well. So it's a satisfying world, but it's also, you know, nothing's easy, right? I guess that's why they call it work.
Are entrepreneurs born or made?
That's a great question. Yeah, with everything, are rock stars born or made, or how, I think that, I think it takes a certain personality. So there's some inherent, you're born with, if you like to take risks, if you have, one of my things was not that I like to take risks and do all this stuff in a way, but I just didn't like sitting in an office and being told what to do. And a lot of my early jobs that I did, they were interesting and great, but I really felt claustrophobic, that I was, and I'd look at the clock, and, just like people say TGIF, thank God it's Friday, people work for the weekend, and when you look at the clock at 3 o'clock and say, oh gosh, I got to work till 5 o'clock, 2 more hours. And it's almost like being in prison. It felt like, it's like, I need to do this because I need the money, because I have to pay my rent and I have to buy food. But this job is so boring, and my boss is a jerk, and I just don't like it. And I would just, even though the people were great, sometimes I really felt like I was kind of in prison, and my life was passing me by, because I was just, watching the clock and waiting for Friday afternoon, and then Sunday night and Monday morning it'd be, oh, I got another week of work. And so I really wanted to get away from that lifestyle, and sort of try to be self-directed. And that was the big driving force for me to become an entrepreneur. So, we're born with, can we take those risks? And are we willing to do that? And many people are not, and they want to just have that stable income and that predictability. But that's dangerous too, because you can work for a company for 15 years or 20 years, and all of a sudden that company goes out of business and, or they downsize and bye bye. And so it's risky to try to take the safe route. So by taking the risks and burdens of, you're going to take the responsibility as an entrepreneur for how much money you make, how much effort you put in, and whether you succeed or fail. And it's not only always a direct comparison that, the amount of work that you put in, well, then the universe knows you put in this amount of work, so you're going to be compensated, right? Sometimes you put in a ton of work and you get nothing. And you get negative, you owe money at the end. It's like, why did I do that? And sometimes you do a little bit of work, but you do it smart and the timing's right and you're lucky. There's people underestimate, I think, the amount of luck of being an entrepreneur because it takes the right timing, you meet the right people, whatever, and things are just right. And then all of a sudden, wow, you really get compensated for not doing much work. So, you have to be comfortable that the world is not fair and it's not going to be fair to you as far as how much work you put in, how much you're going to get out. It's not that kind of a thing. And to understand that luck plays a big role in it. It's a combination of you're taught because you have to learn these skills and, you have to learn marketing and you have to learn management and leadership. You have to have a vision that you can call forth for people. You have to have good products or services and ability to communicate that so people know, wow, this is really valuable to me. This can help me so that they see the value in what you're doing. And you have to price it right so that you can make a profit, for what you're selling your products or services for. So there's lots of things you have to learn, but you also have to have that innate mindset that you're willing to take responsibility for your actions and you're willing to fail. And once you fail, you start right over again, and you keep doing it until you don't fail anymore. And, Winston Churchill, I love that quote, he said, success is going from failure to failure and not losing enthusiasm. And that's really it. You just got to keep being excited and get up every day and say, and not be depressed and say, oh, why did that happen or anything? You just have to, say, this is the way it is. I'm either going to do it or I'm not, and decide to do it and change what you can and be comfortable with what is outside of your control and move forward. So it's a good question, Richard. I think it's actually at the end of the day a blend of a personality traits that we're kind of born with, and then an ability to take on responsibilities and to be a continual learner. You have to learn constantly. I mean, it's not even that you have to learn all this stuff and then once you learn it, oh, now it's going to be smooth sailing because the environment's changing all the time. Think of all the new technologies that come out, new ways of doing things that we constantly have to be, reinventing ourselves. And it's not just learning. A big part of it is what they call unlearning, where you have ways of doing it in the past and they're no longer those beliefs or those mental models or those ways of doing things no longer serve us. We have to discard those and unlearn those and then learn new ones. So it can't be like, well, we've always done it this way, so that's the way we're going to do it, because the world is constantly changing, especially nowadays. I mean, we're just like living in a world of such rapid change. It's incredible. It's exciting, but it's also can be disorienting, so.
Where can people learn more about you or follow you?
Well, they can follow me on any of the social media. I'm on, Facebook and X, Twitter and LinkedIn. And I have a Substack newsletter and a LinkedIn newsletter and an email list. The best place probably is at my website, mba-asap.com. That's a good place to go and find out about me and to get in touch. So I'd love to get in touch with anybody.
We have a few minutes. You have a book. I know you have several books. Can you talk about one of the books that would be good, like for corporate finance?
Oh, excellent, Richard. Yeah, I currently have 61 books published. 61. So I've written a whole bunch of books, and one of the reasons I do that now is because it's so easy to publish them through Amazon and Amazon's tools for publishing, their Kindle Direct Publishing. And my best, lately, what I did recently was I put together a series. I started a series called ASAP, and the S as a dollar sign. And it's sort of a series, sort of like, this and that for dummies, those kind of series. And so I have a series for corporate finance, and it's 4 books. And the first book is Bookkeeping ASAP, because that's the fundamentals. How do you keep your books? How do you do debits and credits? And when money comes in, where does that go into the accounting system? When you have to pay a bill, where does that, go? So bookkeeping, and then the next in that stack is accounting ASAP. And so that's the accounting systems, how to do that. And the end product of accounting is financial statements. Those are the financial reports. That's a balance sheet, an income statement, and a cash flow statement. And understanding how to read those and how to analyze those is key. So it goes bookkeeping ASAP, accounting ASAP, and then financial statements ASAP, because that's the next step. And then once you know financial statements and you know all that retrospective stuff, the reporting stuff through accounting and bookkeeping and reading financial statements, the next book is Corporate Finance ASAP. And that's the prospective part about doing forecasting and discounting cash flows back to a present value, net present value, internal rate of return, and all. So those are sort of the building blocks. And the best way is to, really the best way is to buy all 4 books and go through each one and learn them all so you know it. But you can start anywhere. You could start with corporate finance and then go back and fill in the knowledge that you don't know about accounting and financial statements and all. But those 4 books I put together as a series to try to help people to really understand corporate finance. And then if you want to understand corporate finance, you need to know the foundational concepts like bookkeeping and accounting, to do that. So thanks. Yeah, that's the books that right now I'm working on a new book too on mental models, the models that we have in our mind to filter and make contact and make our decisions in the world. So that'll be my next book.